I appreciate several viewers and followers of FutureWise Energy's comments and questions. Most of these are offline. Upstream oil is a very chatty industry, but just as when I was an insider, not openly. So that gives me a unique voice today. Well, today let's consider four views or questions that recently came my way. One is, remember the Italian investor unfamiliar with upstream oil who likened the business of running an oil company to that of running a donut shop? Well, how does that feel a decade later? Was he right? Two, how much running room is really left in the Permian to continue giving the U.S. a political advantage in the world? Good question. Three, aren't the oil barons just arrogant tools enjoying the privilege of upper class? Four, is oil really driven by supply and demand? Is it traded on a free market? Well, let's talk about the question of how much real running room remains in the Permian shale. That's indeed a complex and multifaceted answer that's required to try to respond to that question. And it's a query that touches on the very heart of the oil and gas industry's future, intertwining geology, technology, economics, and geopolitics in a way that defies a simple answer. But let's begin with the geological aspect. The Permian Basin has proven to be an extraordinarily prolific oil and gas province, consistently surprising the industry experts with its resilience and productivity. As of July of 2024, the newly completed wells in the Permian were producing an average of 433,000 barrels per day in their first full month of production. They also produced 780 million cubic feet of gas per day. These figures probably mean nothing to the common person. So let's say that oil is selling for $70 per barrel and that natural gas is selling for $2 per thousand cubic feet. Well, those average figures for the first month equate to about $32 million per day. Now, that's an average during the first month of a new well that is on a steep decline. So, and it may have cost well over $5 million to drill, hydraulically fracture, and complete, as well as equip the well, in addition to the cost of securing the rights to actually drill the well in the first place. And those rights are granted by the mineral owner. And mineral owners in the past few decades have bargained for about 25% of the proceeds. The state of Texas takes about 4.6% out in taxes for the oil revenue and about 7.5% of the revenue from the natural gas revenue. And then the counties in Texas receive ad valorem taxes that usually range from 2 to 4% of the total revenue from both oil and gas. There's also significant cost to operate the well safely and efficiently. So hopefully I've given you and kind of characterize what those volumes mean in terms of revenue. But keep in mind that that revenue is falling just as dramatically as the initial oil and gas rates that are encountered in these shale wells. So then the next question is, how long can this productivity be sustained? And that's not easily defined or answered. Producers hold their knowledge of the extent of these shale deposits close to the vest. That is, the advantage in a competitive game between operators is to protect their knowledge of these reservoirs of shale and the hydrocarbons within them. So the nature of shale plays is such that individual wells experience rapid initial production and then they have a steep decline. And the industry has countered this natural decline through continuous drilling and completion of new wells in addition to the enhanced recovery techniques that they've deployed. Permian crude oil production is projected to average over 6.6 million barrels per day in 2025, even higher than 2024. Now, this growth that's expected, at least in the near term, suggests that the Permian still has significant running room if you believe the government agency and the surface analysis by some data vendors with some experience in this game at estimating the future based on recent trends. Keep in mind that data collection and reporting in the oil business is very complicated. An important point that was pointed out by a follower is that not all wells are created equal. The Permian, like any oil field, has its sweet spots, areas of higher productivity that are typically drilled first. As these prime locations are exhausted or drilled up, companies must move to less productive areas then, and that lowers their returns over time. So this heterogeneity in well performance is a key factor in the complexity of estimating a oil or gas basin's long-term potential. Now, the term heterogeneity means there's a lot of difference. It's like driving through lake country in Wisconsin and crossing into Iowa, and suddenly there's dramatically fewer lakes. So the economic side of the equation is equally intricate. Oil prices play a crucial role in determining the viability of drilling projects. The cyclical nature of oil introduces a significant element of uncertainty into the long-term planning. So when prices are high, previously uneconomic reserves become attractive, effectively expanding a basin's potential. Conversely, or on the other hand, low prices can render even what were promising projects to be unviable. So the absence of a truly free market in energy is potentially an astute observation. While supply and demand fundamentals certainly play a role, the energy market is heavily influenced by geopolitical factors, government policies, tariffs, and strategic decisions of major producers. The impact of trade wars, tariffs, and other political interventions can indeed cause the serious big money to pause, potentially slowing development even in a promising area like the Permian. The capital intensive nature of oil and gas development, particularly in shale plays, adds another layer of complexity. These projects require substantial upfront investment, often running into the billions of dollars. The willingness of investors to commit such large sums is influenced not only by current oil prices, but also by long-term price forecasts, regulatory environments, and broader energy transition trends. So the role of technology cannot be overstated in this discussion, but it's not alone as something that we need to consider. Continuous improvements in drilling, completion techniques, they've allowed operators to access reserves that were previously considered uneconomic. And the EIA notes that operators in the Permian are successfully implementing more advanced techniques, including longer lateral lengths, optimized well spacing, and enhanced fracture designs, as I've mentioned in some of my earlier videos. These technological advancements have the potential to extend the basin's productive life, but they also introduce uncertainty into the long-term forecast because we just don't know for sure how large these shale opportunities extend. So the broader context of the global energy transition adds yet another dimension to this question. As the world grapples with the need to reduce carbon emissions, the long-term demand for oil and gas becomes less certain. This uncertainty can impact investment decisions, potentially limiting the development of new reserves, even in prolific basins like the Permian. The difference between running a donut shop and an upstream production company is that they are starkly different businesses, even today. The complexity, scale, and long-term nature of oil and gas projects set them apart from most other businesses. The interplay of geological uncertainty, technological innovation, market volatility, and geopolitical factors creates a uniquely challenging operating environment. However, given the threats of tariffs and trade wars, droughts and disease, or supply chain interruptions that threaten a donut shop's cost of ingredients, does liken it to some degree to the uncertainty of selling oil at uncertain future oil prices. The notion that these operations are run by a privileged few, or maybe the 1%, does touch on an important issue of transparency and governance in the energy sector. While the industry has made strides in improving transparency, the complex nature of these operations and the competitiveness within the industry have far reaching impacts on society and the environment. And so we continue to raise questions about the accountability and social responsibility. So, in conclusion, the Permian Basin continues to demonstrate impressive productivity and growth potential in the near term. The question of its long term running room remains open. The answer will depend on a complex interplay of geological realities, technological advancements, and economic conditions and policy decisions. As we navigate this uncertainty, it's crucial to maintain a balanced perspective, considering both the economic benefits and broader societal and environmental implications of continued oil and gas development. I'm Mark Roach, wishing you all the best.